Hey guys, thank you for joining me on this video. It has been a long time coming and I hope you guys are excited, just as excited as I am to check this out. This is the official 1-year update on this WeBull app, little small portfolio experiment that I've been doing. Last year, pretty much right at the tail end of 2018 in December, I started this very small kind of project, very conservative, long-term type of project. I have not been day trading. I have not been swing trading. I've been holding these positions for the entirety of the year pretty much. And so I wanted to show you guys the official ending to that first year. So just to recap, I put in $100 into WeBull. I bought a Roku stock and one AT&T stock at the time. That was all that cost me, less than $100. So slowly over the year, I have only added $65, I believe. Actually, possibly more. I can't quite remember. We'll see right here in a second, but say $65 to $85. So with a grand total of about $165 to $180. So it didn't stay at 100. If I got a little bit more money, or if I saw a stock that I really wanted to buy into, I added a little bit more money to it. But this is still an extremely low valued profile or portfolio, using very little money. I mean, I'm sure most of us could probably set aside $100 and get a portfolio like this started, less than $200 to kind of get this going. And mostly what I did this for was to get a better understanding of when a good buy-in is. And considering that I haven't been selling, kind of just keeping an eye on good sell points, even though I have not sold anything that I've purchased in the last year. So without further ado, I'm not going to waste your time. Let's go check it out. So as you can see, I have in 1 year managed to get a 55.83% return on this very small portfolio. So I have halfway to doubling my money within 1 year. And I'm sure you guys are aware that that's a better rate of return than any savings account that any bank can offer you, as well as any money market account, any sort of life insurance with a cash value, anything like that. Like, this is absolutely a much better rate of return. And what that means is my money stands to double in way less time. If you consider the rule of 72, it's going to double in way less time than most other investment vehicles. So I'm really proud of that. In 1 year, I have learned an immense amount of just stock market patterns, trends, things that just kind of affect it for seemingly no reason. It's pretty interesting. So if we take a look, I still have Roku. I'm going to start from the bottom up. Roku, I still only have that one stock. I bought that stock when it was valued at $28. It had plummeted at the end of 2018, only to, as you see now, be my best performing rock star of a stock. I only wish I'd bought more. That stock is now valued at $133.80. And I know what you're thinking. Why have you not sold that yet? Why would I? Why would I ever sell that when the return, I mean, I don't know if you can see it. You should be able to see it. That's a 377% return on that one stock alone. And why did I pick Roku? Because I like technology. I know technology. I like technology. I like to keep up with technology. Number one rule that I could suggest to any of you guys that are thinking about, investing in the stock market is to invest in what you know. Invest in what you understand. So if tech is not something you know or understand, please stay away from it unless you want to know about it. But that's kind of like just the main rule. Invest in what you know. I still have that stock of Roku. It has been my best performing stock. I will not sell that stock. In fact, if I ever see a dip to any sort of low, if it were to dip or crash or anything like that, I would actually buy into it some more. I've been waiting since the day I purchased that first stock to see if it would ever go back down towards 28, and I have yet to see that. So Roku is great. AT&T, I bought one of those and then ended up liking it so much that I bought another one. I bought into AT&T at $28.18. And as you can see, that one has been a very slow and conservative growth, whereas Roku, you have this like skyrocket up that corrects itself halfway down, skyrocket up, kind of very volatile, very crazy. AT&T is the exact opposite. It has very conservative growth. It is very modest in its movement. It's not extremely volatile. Even when AT&T seems to have a bad news day, it doesn't, spike down. Also, what I like about AT&T is it has a good dividend. So that was another thing that I wanted to focus on in this particular project, was stocks that I am aware of, that I am well versed in, that also have a good dividend. So AT&T, Coca-Cola, and Bank of America are 3 stocks that actually pay me dividends. And those are 3 stocks that I consider to be those conservative, not volatile, very almost, what's the word? You can almost count that these are going to stay within the same range. Within a year, obviously you can see within 1 year, AT&T has gone up $10 in value. Coca-Cola has gone up $10 in value, and Bank of America has gone up almost $10 in value. So once again, very conservative and consistent growth. That's what I'm looking for. When I first started day trading and swing trading in the stock market, I wasn't thinking about consistent growth over time. I was thinking about immediate growth in as little time as possible. And I think that's what kind of the mentality that a lot of people go into when they start trading. So that's why this project was really important to me. It was important for me to be able to slow down and see the trends and really understand, how it all is affected. And then last but not least, as I'm trying to make this a pretty quick video, we have Aurora Cannabis. Very recently, I decided to invest in the cannabis market. Once again, it's something that I know. I understand it. It's very second nature to me. I live in Colorado. I'm from California. Very well versed in cannabis. That, as you can see, is my worst performing stock. I did not go in at a right time. I thought I did, and this goes to show you that, you're still learning. I thought I went in at a good time, and it looks like very soon afterwards, almost every single cannabis stock on the market experienced a bit of a crash. And so that's where I'm at right now. I bought in at $5.59. It is valued at $1.86. This is another thing I hear all the time. Why haven't you sold? I think the difference, at least one of the many differences between day traders, swing traders, and long-term investors is that level of, I've seen how things can change over time. I understand that even though something is extremely low right now, what goes down must come up. It's just a rule. And so I'm sticking with this. As a long-term investor, I'm going to stick with these 8 shares. The amount of money I can lose is minuscule compared to the rest of my account. It's a penny stock. It's one of the only stocks I'm willing to experiment with, and I think it's important to do that. If you're not 100% sure, you're still gauging when a good buy-in time is, it's good to hold on to something. Don't get in and get out so quickly when you find that you're losing money, unless obviously all of your money is at stake. But give yourself a small percentage of your portfolio to be able to experiment with stocks like this, more volatile penny stocks of kinds, markets that are still in gray areas legally, things like that. I mean, maybe not legally, but even though that's what, cannabis is, don't give yourself no money to experiment with things like that. Give yourself a small percentage of your portfolio where you are going to possibly lose and, figure out if that was ever worth it in the end. But as of now, I'm holding on to Aurora Cannabis with no plans to sell it anytime soon. That's something that I believe that in 10 years will be astronomically higher than just $1.86. And so before I end this video, I know it's probably a long one, I want to definitely stress the importance of your watch lists. This is how I know when a good time to buy in is. Honestly, I like to buy a stock when I see a sharp, massive correction going down or just bad news day. So one of the things that I look at constantly is the percentage change of these stocks. So currently, if you look right now, Beyond Meat has a 10% increase. That's great, fantastic. Beyond Meat is a stock that impresses me, considering how fast it flew, how high it flew, and then how massively corrected it became. So if you see, at one point, Beyond Meat was valued at $234. And now it's right back down to 90. So that's the kind of things that I look at when you see that a stock has reached this massive pinnacle and then had a huge correction. Say, within a week, you've lost $100, massive amounts of percentage. That's when I like to buy in. You do run the risk of buying in and having that stock continue to fall. That's absolutely going to happen. But one thing I always keep in mind is that on those massive red days, on those days where those stocks on your watch list are experiencing huge losses, those are the days to buy in, double down on your position, do what you got to do, get those high or at least consistent dividend stocks that have, for whatever reason, experienced a red day or a few red days in combination, because as a long-term investor, for the most part, these things will go back up again. They're going to recover. What goes down must come up. What comes up must come down. These are just kind of the rules. There are always exceptions to the rules, guys. Please don't take my word, my words as stone. But definitely realize that when you give yourself more time and you give yourself, more thoughtful procedures and you really think about those moves that you're doing, you do have a better chance of coming out successful, financially successful, and also just more educated on the whole matter. So thank you guys so much for following me throughout this year. It's been an absolute pleasure to be able to try this experiment out. And I guarantee I will try and get more videos out. I will try and put more money into this account, get it growing, get those numbers going. But, and I forgot to mention, because it really doesn't matter at this point, but this account had gotten to a 90% return. Of course, that, like you could say, well, why didn't you sell then? Well, say I did sell at 90 and it continued to go. And that's kind of the thing that we think about. Like, this for me isn't a savings account. This is a retirement account. This is money that I want later in life, much later in life. So I'm going to give it the time it needs to double in value, as opposed to making a quick buck and pulling it out immediately. Like, this is not how I view this profile. And that's, essentially how I started, but I have very much changed my ways of thinking. I 100% fully endorse a long-term investment approach. Not to say that I don't admire day traders and swing traders for what they do and their ability to do it well, But I do believe that if you're interested in investing in the stock market as a means of a retirement account, a long-term approach is going to be a better plan for you. All right, guys, thank you so much for following me. Thank you. If you like this video, please hit that like button. Please leave me a comment. I'll try to answer any questions as best as I can. And I hope to hear from you guys. Until next time.